When foreign investors look at Vietnam, most of their attention goes to market opportunities, growth, manufacturing, technology, consumer demand, or strategic positioning across Asia. But in practice, many of the biggest commercial problems that foreign investors experience in Vietnam are actual structural problems, not operational. Unfortunately, by the time those structural problems become visible, the investor is often already committed, the capital is deployed, relationships have become complicated, and changing the structure becomes expensive, slow, and sometimes politically difficult. Today, I want to run through the critical structural decisions that foreign investors need to make when investing in Vietnam. So the key question here is, should an investment be held directly onshore in Vietnam? Or should there be an offshore holding structure, commonly through a jurisdiction such as Singapore, sitting above the Vietnamese operating company? Now, this is not saying that one structure is always correct. There are situations where direct investment in Vietnam makes complete sense. But there are other situations where offshore structures create significant legal, commercial, governance, financing and transaction advantages that investors often do not fully appreciate at the beginning. So, I will compare the two approaches from the perspective of the governance, investor protection, future capital raising, dispute management, distributions, and future exits or transactions. Importantly, I also want to talk about some of the common mistakes that we see foreign investors make when they structure their Vietnam investments. So we will start with the most fundamental structural question. Do investors hold shares directly in the Vietnamese company? Or do they hold shares in an offshore holding company that itself owns the Vietnamese operating entity? In Vietnam, foreign investors will commonly invest directly into either a Vietnamese LLC, which is a limited liability company, or a Vietnamese JSC, a joint stock company. Now, both are legitimate structures, but they operate quite differently. Vietnamese LLC is generally simple operationally. It's often used for wholly foreign-owned subsidiaries, consulting businesses, service companies, manufacturing operations, or closely held investments. But an LLC does have its limitations. Ownership transfers can often be slower, governance is more rigid, and minority investor flexibility is quite limited. A Vietnamese JSC, on the other hand, is more flexible from an equity perspective. You can have different shareholders, potentially different share classes, and structurally more suitable for future fundraising or broader ownership participation. But the governance and compliance obligations are generally more complex. Now, on paper, investors often think we'll just sign a shareholders agreement and deal with the governments that way. But that's where many foreign investors misunderstand, because in Vietnam, the company charter is critically important. And practically speaking, shareholders' agreements do not override the charter in the same way investors may expect in jurisdictions like Singapore, England, the United States, or Australia. That means that enforcement can be difficult, injunction-style relief is limited, disputes can become heavily procedural, and litigation or enforcement timelines can become very slow. So while investors may believe they have contractual protections, the practical enforceability of those protections inside Vietnam can be very different from what they expect. Now let's compare that to an offshore holdco structure. A common model is a Singapore holding company which owns 100% of the Vietnamese operating entity. That creates quite a very different governance framework. At the Vietnam level, the Vietnamese company can operate relatively cleanly and simply as a wholly foreign-owned subsidiary. Operationally, this simplifies the governance, the licensing, the management structures, and investor coordination. So, for example, instead of a complicated jointly owned Vietnamese entity with multiple foreign shareholders, the Vietnamese company may simply operate under a chairman or corporate governance model through the offshore parent. The bigger advantage is usually investor enforceability and governance certainty at the offshore level. At the Singapore holding company level, shareholders' agreements are generally more sophisticated, corporate law is more predictable, enforcement mechanisms are stronger, injunctions are realistically obtainable, and dispute resolution frameworks are usually much faster and commercially practical. This all becomes critically important when investors start to disagree, founders separate, dilution events occur, or future transaction opportunities arise. Now, importantly, offshore structures are not automatically superior. They introduce additional compliance, offshore accounting, additional tax analysis, substance considerations, transfer pricing considerations, and ongoing governance obligation that differ across multiple jurisdictions. There's also a cost layer that smaller businesses sometimes underestimate. So for smaller or simpler operations, direct investment into Vietnam may still be entirely appropriate. However, where there are multiple investors, sophisticated capital arrangements, future fundraising plans, or material governance risk, offshore structures often create a much more commercially manageable framework. The second major issue is capital structuring flexibility, and this is one area where offshore structures can become extremely powerful. At the Vietnam level, capital injections are highly regulated. Foreign investors generally contribute their charter capital or maybe foreign loan capital. Both are registered and regulated differently and quite fixed in their process. So capital contributions require registration, ownership ratios that matter depending on what you contribute, the charter amendments may be required to reflect that, and licensing implications can arise. Foreign loans also operate within regulatory frameworks with loan registration, reporting obligations, foreign exchange controls, and debt compliance requirements. Importantly, investors cannot simply create unlimited flexibility between different investor rights or loan holder rights inside of the Vietnamese entity. For example, you have different investor priorities, preferred repayment waterfalls, highly customized debt equity arrangements, or aggressive preference structures. These can be quite difficult or impractical at the Vietnam operating company level. Now let's compare that to an offshore holdco structure. At the offshore level, investors can often structure capital much more flexibly. For example, all investors may subscribe for shares in the Singapore holding company with differing rights, but the holding company itself may invest those shares, that capital, into Vietnam using a mix of equity and shareholder loans. That can create multiple advantages because it may improve repatriation flexibility, reduce trapped capital risk, create priority repayment mechanisms for selected investors, and better manage the downside protection. It also allows investors to structure different commercial outcomes between themselves. So for example, one investor may receive preferred returns, another may prioritize capital growth, another may have loan repayment priorities, another may have governance rights without equivalent economic participation. That type of flexibility is often far easier offshore than directly can be achieved inside Vietnam. But again, there are trade-offs. Offshore debt structures must still consider transfer pricing, withholding tax, thin capitalisation, beneficial ownership, and treaty access, not on top of substance requirements. So while offshore structures increase flexibility, they also increase technical complexity. And poorly implemented offshore structures can actually create tax inefficiencies if they're designed purely for convenience without proper planning. The third issue is investor alignment and economic structuring. And this is another area where offshore structures often provide significant greater flexibility. At the Vietnam operating company level, ownership rights are comparatively rigid. While JSCs provide more flexibilities than LLCs, Vietnam is still generally less adaptable than jurisdictions such as Singapore when it comes to highly customized shareholder economics. Investors often assume they can easily create different dividend rights, different voting rights, redemption mechanisms, liquidation preferences, or customized investor waterfalls. But practically speaking, implementing and enforcing these arrangements directly inside Vietnam can become very difficult. This is particularly so where you've got local founders or foreign investors and future investors all having different commercial expectations. At the Singapore holdco level, however, investors can structure much more sophisticated arrangements. For example, you can create preferred shares, dividend streaming rights, different voting classes, convertible instruments, redemption rights, vesting arrangements, founder protection mechanisms, or future dilution protections. where all of this becomes very important, particularly where you're dealing with startups or growth stage businesses, you're looking for private equity structures or strategic partnerships. Because the offshore structure effectively becomes the commercial and governance platform, while you then have the Vietnam entity becoming the operational platform. For many international investors, that creates a much more familiar and investable framework. One of the common mistakes we see, though, are investors attempting to force highly sophisticated international investment mechanics directly into the Vietnamese operating company itself. Sometimes it works, but often creates governance confusion, enforceability risks, licensing complications, and operational tensions later. The fourth and the final major consideration I want to talk about is the future transaction flexibility. It's one area that investors frequently underestimate at the beginning of the journey. So if investors hold shares directly in a Vietnamese company, future share transfers can trigger M&A approval requirements, licensing amendment, competition approvals, investment registration changes, foreign ownership analysis, and regulatory processing timelines that can occur. Sometimes the approvals are straightforward, sometimes they're not. But importantly, the legal environment in Vietnam continues to evolve. So future changes in foreign ownership rules, licensing policy, or sector restrictions, or even administrative interpretation can materially affect transaction timing, value, and certainty. There's also the issue of direct Vietnamese capital gains tax exposures on transfers. Now let's compare that to an offshore holdco disposal. If investors sell shares in the Singapore holding company, the Vietnamese operating company itself may remain unchanged. The operational licenses may remain untouched. And the transaction can often move very much faster commercially. That speed does matter. It especially matters in M&A transactions, private equity deals, strategic acquisitions, or distressed restructures. Now importantly, offshore transactions does not necessarily eliminate Vietnamese tax exposure. Vietnamese tax may still apply in indirect transfers connected to underlying Vietnamese assets, but there are many more options to make any transaction tax more efficient. In some cases, there are competition approvals still required, economic concentration approval, or anti-avoidance considerations that may arise. So offshore structures are not a complete exemption from Vietnamese regulation, but they often provide materially greater transaction flexibility and execution speed. And in real-world transactions, speed and certainty can materially affect valuation outcomes. So, ultimately, there is no universal correct structure for Vietnam. Some investments should absolutely be held directly onshore, and particularly when you have small operations, single investor structures, or businesses without complex governance requirements. But where there are multiple investors, future fundraising plans, strategic transaction expectations, or sophisticated shareholder arrangements, or if you're dealing with long-term governance concerns, the offshore holding company structures can create very significant commercial advantages. Ultimately, structure matters much earlier than many investors realise, and fixing a poor structure later is almost always slower, more expensive, more political, and more disruptive than getting it right at the beginning. Vietnam remains one of the most compelling investment destinations in Asia. Investors should be approaching their Vietnam structuring decisions with the same seriousness that they apply to their commercial due diligence, financial modelling, and operational planning for their business. In Vietnam, the chosen legal structures directly affect control, enforceability, flexibility, the investor protection, and ultimately investment outcomes. Thanks for watching. If you'd like to see more discussions around Vietnamese investment structures, compliance, governance, and transaction strategies, feel free to subscribe, and please comment below if you'd like to add your thoughts on this topic. See you next time.